Good morning. We're still in the morning. So the marking key of assignment number 5 has been posted. I got some question about the assignment, and so I just want to spend a few minutes on that. It's about the discount rate used, and because discount rate is the one that
on the screen, man.
Calculation, and
I'm famous. Wait, where did she go?
okay, yeah. So if you use a different rate, your calculation. Ryan, my mic is still on. I think Ryan's still on. Where's Ryan?
That was because somebody's mic was on in the background.
Oh, okay.
Yeah.
Okay, so do you want to speak, Ryan, now?
No, I was just letting the person know whose mic was on. That's all.
Oh, okay. So I will mute. Okay. Fair. Good. Now we're good. So I want to spend a couple of minutes on that because the rate is what you use to calculate. And if you use a different rate, the whole question pretty much is different. And so I just want to first let you know that if you use the wrong rate, you will lose the mark. I think it's a four points for that, I think. But as long as going forward, you use the number that's consistent with the rate you use, that's fine. You should not be double penalized for that. Okay, so that's just first thing. Second thing, let me just clarify about the rate altogether. So let me use this slide. I'm just going to borrow an empty slide to do that. Okay, so this is okay. So let me just why would I not be okay, I will just borrow a slide here. Okay, that I don't mind what's in here. That's just say new slide. Oh, I hate that. What are these things? Couldn't I just get a blank slide? Oh my gosh. Okay, let's try again. Oh my gosh, it's even more. Okay. Let's go back to this one. At least it has less. So let's just say the discount rate for lease. I'm not. Am I sharing? Oh, it's paused. Thanks for reminding me. How do I stop sharing? Let me share again. I think the weather is affecting this somehow today. So discount rates for leases, let's say that. So there are two rates, okay? So we're aware there exists two rates. One is the implicit rate, the lesser rate, lesser or implicit rate, and lease's incremental borrowing rate. So there are two rates. Now, the lesser rate is also called the implicit rate. You know, there's a reason for that, because lesser sets the rental payment, lease payment, okay? Because lesser as an investor has an expected return to earn for being a lessor. And so we assume that the lessor sets the rental payment to ensure it will earn this expected return. So lessor's rate is implied in the rent. That's why this is said. So first of all, lessor sets the rent. I was going to say rental payment to ensure that lessor will earn an expected rate of return. This is the lessor's rate. So lessor, when the rent always reflected this lessor's rate. Okay. So when you have a question, ask you to determine the rental, what rental should be, ask you to confirm why the rent is such, you always use lessor's rate. Okay. And from leasee's perspective, leasee does not need to calculate rent. Leasee does not set rent. So leasee's calculation is always given these are the rentals I agree to pay. And under SB, if it's a capital lease, I need to capitalize it. So I need to calculate the present value to be capitalized. And if under IFRS, almost all the leases, you need to capitalize it. So you need to calculate the present value of the lease in order to capitalize it. Present value require discount rate. So which rate to use? Here, you may have two rates. You may only know one, even there exist two rates, but the leasee does not always know lessor's rates. Lessor is not obligated to publish its rates. Sometimes the leasee can figure it out. Sometimes lessor make it known. Sometimes it's not the case. So leasee may not always know lessor's rate. When leasee doesn't know lessor's rate, he can't use it, right? So that in that situation, leasee can only use its own incremental borrowing rate, right? For leasee, if if it doesn't know the lesser rate, it has to use its own incremental borrowing rate. Right? That you don't have a choice. You don't know what you don't know. You can't be responsible for what you don't know, and you can't use the rate if you don't know what it is. Now the question, the IFRS and SB separated here, it's if the leasee knows lessor's rate, then leasee has to choose from the two rate, right? If leasee knows the lessor's rate, then under do this. Oh, okay. One should not be there. Here's under IFRS, leasee has to use lesser rate if it is known. I have to just be short because in case you just read this sentence, didn't read the sentence before, you read problem. Under IFRS, leasee has to use lesser rate if it is known. Under SB, leasee has to use the lower of the lesser rate or lower end, lower of this, and leasee incremental borrowing rate. Obviously, if it knows that, right? If the lesser rate is known. Just to be clear, if the lesser rate is known. So that's a summary of all the situations. For lesser only use its own rate. Lesser sets the rent. So whenever we talk about the why the rent is such a level, you know, could you determine the rent? You always use lesser rate because it's in reality, it's lesser sets the rent. Lessee may have a choice, right? There are two rates. In the situation that lessee does not know lesser rate, there's no choice. Its own incremental borrowing rate, that's it. But if lessee knows lesser rate, then they have to choose. The choice is different. In our example, because if lesser rate is less than lessee's rate, the choice will be the same between IFRS and the SB, right? And that's why like it was not an issue when we discuss the contents of the chapter in the class, because our example, if you go back to look at it, that we have two rates, lessee knows both rates, but lesser's rate is lower than lessee's rate. So your choice doesn't matter which gap you are using, it would be the same. Okay, so this chapter has those kind of details. Another detail is the residual value, which we talked about. The residual value, lesser use residual value regardless it's guaranteed or not, whereas lessee ignore the residual value if it is not guaranteed, but you must take consideration if it is. Okay, so that's about that. Let's move on to the next chapter, which is statement of cash flow. Now, I'm not sure why I cannot, let me fix it. I'm not sure why I cannot change it. I don't like that. Why cannot I not change it? Let me fix it. Let's download it again. I need to change it. I need to be able to change it. All right, now we're good. Yeah, I think now we're good. Let's hope. Okay. Okay, we'll look at all the topics. So we skipped chapter 21, which I believe you covered in 3351. So this is the last full chapters of this course. Okay, and this is the last chapter that would be, yeah, we'll cover everything pretty much. So statement of cash flow. Okay, so the first, we will look at the statement of what is cash flow, what's the statement of cash flow. I want you to think back in 2241 when you first learned to record accounting cycle, record transactions, make adjustments, prepare trial balance. And the end of that cycle is preparation of financial statements, right? From adjusted trial balance, you prepare income statement, statement of retained earnings, and the balance sheet. Did you notice that there is no statement of cash flow? So the statement of cash flow requires more work. Statement of cash flows depends on the statement of financial position and income statement and additional information. You need to analyze all that in order to prepare statement of cash flow. So both income statement and the balance sheet, they're accrual-based statements. Income statement measures, reports financial performance, balance sheet reports financial positions, and so they complement each other and so on and so forth. However, there's a gap because in addition to accrual-based earnings, cash is also very important. You can't pay bills with your net income, right? You can't pay bills with net income. So statement of cash flow complements the other 3-4 statements to fill in that gap. It explains how the cash has changed, what are the sources of cash, what are the uses of cash, and over the years, this statement has become like more important. Another reason people prefer or think statement of cash flow is important is, unlike income statement, subject to estimate, subject to assumptions, because accrual-based accounting requires you to recognize revenues, expenses as they are earned and incurred. Sometimes there's no hard evidence, right? Whereas cash flow, you either get paid or you didn't. You either made payment or you didn't. So it's less susceptible to manipulations. That's another reason it's considered important. Okay. As I said, the statement of cash flow reports inflows and outflows of cash, but it does so in 3 categories. It separates operating cash flow from investing and the financing cash flow. Okay, so remember, operating results is mostly the contents of income statement, and the balance sheet shows the results of financing and the investing activities. Statement of cash flow covers the cash aspect of those activities all in one. Okay, and it also ties to the balance sheet because the ending balance of the cash would be, the beginning and the ending of cash would be the same as the cash balance in the beginning and ending balance sheet. So like it articulates with the rest. Okay. Here is an example just to kind of illustrate what we said, right? So here I have the 2 years balance sheet. Well, it's the beginning and the ending of 2020, and the 2020's income statement. So it shows like this company called Lakeside Properties. It has a profit of $250,000. Okay, so that's not nice. But then you look at the cash. How come you earned the profit of $250,000, yet your cash balance reduced by $100,000? What happened, right? Because as we said, sufficient amount of cash flow is critically important for the company to survive and to continue its operation smoothly without being interrupted. And so does that mean that company has cash flow problem? Why the cash reduced by half? Well, they clearly had been profitable. So a close look at this was the short answer is, this income statement is accrual based, right? So just because you have $250,000 profit doesn't mean you end up with $250 cash from your operating activities. Okay, so for one, we can look at this. So your revenue is from sales, I think that since it's a property rental revenue more likely, is 600,000, but does not necessarily mean you get 600,000. In fact, if you have a closer look at this set of financial statement, you know it's not 600,000. How do I know? Here, you look at accounts receivable, right? At the beginning of 2020, there's no outstanding accounts receivable. But at the end of 2020, there's a 50,000 accounts receivable outstanding. What does that mean? Like accounts receivable is related with the credit sales. Okay, if you make the sales didn't get paid, your accounts receivable go up, right? So that means 50,000 out of this 600,000 revenue is not only credit sales, but it's still outstanding, right? So in other words, if that's all relevant, I would say the cash collected, I'm just going to put it in red. So it's only 550 collected. So I will put it the cash. Cash collected. Yeah. Does that make sense? Yeah, so there's a difference. The accrue income does not necessarily mean cash received. Accrue expenses does not necessarily mean cash paid. So that's not all the differences, but that's difference, right? So depreciation expense. Actually, there's no cash at all, right? Because think what happened is that this is a property company, so it has buildings and may be equipment as well. And this depreciation expense is the allocation of the cost of the properties and the equipment and any other long-term assets to this period that these properties are being used, right? So the cash associated with this properties and the equipment first may not be paid this period. We have buildings, probably, maybe it's paid a long time ago. Maybe, you know, the amount paid is different. We don't know. Secondly, the cash paid to purchase buildings and equipment, properties, is not operating cash, right? It will be investing cash flow, right? And so income statement focus on operating activity, not exclusively, we're going to come to that, but mostly, right? So here there's a zero cash, right? And then this other expenses of $250,000. Well, they may not be same as cash either. So let's have a closer look at this. What are the operating expense? It's always easier to understand if we use an example. So since this is property company, so let's say wages expense, maintenance expense, insurance expense, income tax expense. It could be interest expense, right? All that. So since it's called operating expense anyway, all other expense, let's have a look. Okay, so we do not have inventory because this is like a condensed income statement for one, and secondly, it's property company, so they doesn't sell goods. So inventory, if there is, will be kind of minimal. But we do have accounts payable. Accounts payable is usually related to goods or services purchased. So here probably services purchased. And let's think the difference between whatever these service expense, let's assume it's part of the other expense. If the expense is all paid, then there should be no payable changes, not no payable, no changes in payable, right? If the expense you purchased and used is exactly the same, if the service you purchased and used and expense is exactly the same amount you paid, there should be no changes in payables, like be it wages payable, tax payable, right? There should be no changes. If you did not pay all service, the expense, your payable will go up. But if you paid more than the service you expense, the payable will go down. And this is the case, the payable went down from 20,000 to 10,000. Okay, so that means even though they recognize the expense of 250,000, how much they paid for expense? $10 more, right? Right. So the cash would be 260,000. Okay, so let's see how that, where that leaves us. With that, changes are, we got actually 290, right? So the cash from operating activity associated with these activities reported in the income statement is 290,000. That still didn't explain, but that's tell us the difference, but it doesn't explain why the cash decreased, because cash can also be used or received from investing and the financing activities. Okay, so if we have a closer look at this, you see the buildings. At the beginning of the year, they have $600,000 worth of buildings. That's the cost. And then the cost of the buildings increased to 850. So that implies they purchased the new building at the cost of 250,000, right? So that's a kind of like I'll create space for that to note it. Okay, that's okay. I can fix it. I'll just make the word, the size a little smaller. Okay, it's okay. I have all the balance sheets here, so I will just do that. So that means here, there is a cash of 250,000. That's not going to fit. Oh, I see why it is. It's so weird. Now I got it. I just need to have, oh, yeah, that's better. Excuse me. Yeah, so now everything fit. So there's a outflow of 250,000 for investing activity. So this is the cash. I will put it cash here. Cash flow. Okay, so I'll actually do better. I will just move all these to here. Move this amount out of here so the notation will be more consistent. Okay, so that's one. What else? What else? Well, we know why this changed, because there's a depreciation expense of 100,000, right? So there's no cash goes with that, but there is additional purchase of buildings. And we already discussed why this changed, and we accounted for that change. But then here, the common shares also changed from 200,000 to 190,000. Okay, so that means there is additional $90,000 shares were issued. Okay, so that should result in a cash inflow of 900,000. So does that explain everything? Not really, because if you look at this, so that's 290, and that's 250. So that still doesn't explain changes. Well, there's one more. Here it is. Retained earning changed from 50 to 200. What does it tell us about the cash flow? Well, first of all, we already know two things change retained earnings. In this simple example, there are other things may change retained earnings, but clearly it doesn't apply to this simple example. One is net income increase retained earnings, and second is if there is any dividends that decrease retained earnings, right? So we know the net income is 250,000, and if you add this 250,000 to the beginning balance of retained earning, there should be a retained earning of 300,000 at the end of 2020, but that's not what we see. We see a 200,000. So what does that imply? There is a dividend of 100,000, right? So that will be cash outflow. And if you, I think that if you include all that together, let me see. Well, anything else? Oh yes, there's one more we didn't see. See that notes payable, right? It was 330 at the beginning of the year, and it's 200. So that some of that must be paid, and the difference must be paid. We just have to assume that without any other information. So now when we include all this together, you get a negative cash outflow of 100,000. Okay, so statement of cash flow will give you all this information, only it is organized, not like haphazardly like we did here. And that's what we're going to talk about. I see you whipped out your little calculator. Yeah, it is negative 100,000. Yeah, okay. So before we go ahead, talk about that for this actual statement of cash flow, one more thing in this little intro section is when the company reports statement of cash flow, they often do not focus cash narrowly. Instead, they will focus on cash and the cash equivalent. Because the reason you focus on cash or cash flows is that that's the most liquid resources, and that serves a purpose, like pay your bills, like maintain your liquidity, you know. But there are other assets, there's very liquid, very similar to cash or near cash, they serve the same purpose. And just like when the cash is scarce resource, right? Like, you know, there's such a thing as time value of money. So you don't want to waste it just putting too much cash in your bank account, because bank checking account right now earns you nothing. Even the saving account earns you very little. So just to manage your resource more productively, companies would invest the cash, but they kill the two stones in one. So on one hand, they will earn some return rather than wasting this very valuable resources, not doing anything. But they invest in such a way that is can be cashed in when you need the cash, so it also serves your liquidity purpose, right? So that's what we do. So statement of cash flow, to be consistent with that, would focus cash and the cash equivalent. And what are these cash equivalent? What are the difference between cash and cash equivalent? Cash is the cash on hand, and on demand deposit means like, you know, you can access it instantaneously. Demand deposit means if you demand it, they will give it to you, right? And also there's very little uncertainty, no uncertainty whatsoever. Cash equivalent, what does it mean? It's like the same, right? So they're almost like a cash, but it's not cash. They are short-term, highly liquid investments. They are readily convertible to known amount of cash. That's very important. That's why usually if you buy a share stock, that will not considered in most times considered cash equivalent, because stock price changes every day, and you know you don't know how much you can convert it into cash when you convert it, right? With the insignificant risk of change in value. So example would be money market funds. Okay, some of the debt securities, some of the, I think there's an example of preferred shares acquired close to their maturity date and can be included in cash equivalent. One note is about overdraft. How do you consider overdraft? Overdraft is negative cash. And so I think in your 3350, there was discussion, is overdraft negative cash, or is overdraft short-term bank loan liability, right? Because, you know, if you think about it, when you overdraft, basically you're borrowing from the bank, you owe bank that amount. So if this overdraft is kind of a part of the cash management policy, like, you know, it's equivalent to short, you know, to how much it is considered when you determine how much cash you should keep, knowing that sometimes you may have to go in the draft, then it will be considered cash and cash equivalent. You know, it's kind of intentional, you know. So that's that, just to keep that in mind. So now then we talk a bit more about the classification of cash flows. We know it's operating, investing, and financing, but there are some details that we need to consider. Okay, so we already know operating, investing, and the financing. This classification is meant to make statement of cash flow more useful, because the implication of cash from operating and investing and financing are different. They review different things, right? They reflect their business strategy. They review different activities. They have different implications in the future. Okay. This, I always find it's useful. So this is what operating cash flows related to operating activities, and it ties the change in cash flows to the change in balance sheet account. Okay, why? Because if you think about it, this is your balance sheet, assets equals to liabilities plus shareholders' equity, right? If you rearrange this balance sheet, you separate your cash into, separate your assets into cash and the non-cash assets, and then you move everything not cash or cash equivalent to the other side, you will have cash equals, this A represents non-cash assets, plus negative non-cash assets plus liabilities and plus shareholders' equities. You take a difference, you introduce this is a change sign, right? When you introduce a change sign in it, change in cash is change in assets, take a negative sign, plus change in liability, plus change in shareholders' equity. You see the connection. So statement of balance sheet has another name called the statement of financial position. And the statement of cash flow also has another name called the statement of change in financial position. So that's very clearly shown here, right? Now, the next part is, because of that, we tied it into operating cash flows related to working capital accounts. So mostly current assets and the current liability. Investing cash flow, think about the investing activities, right? So that related to buying long-term assets, selling long-term assets. So that is related to change in long-term assets on your balance sheet. And the financing activity, borrowing from the creditors or raise capital from the shareholders and pay back principals, dividends, right? So financing cash flow are related to changes in long-term liability and equity account. Makes sense, right? But actually that's like a very low definition discussion, like highly aggregated. So we do not, we can take it further, a lot further than what I have here, but I take it a little bit further, so make it a more relevant to the discussion we're going to have later on, right? So as what they said, we separate current and non-current, but in addition to that, I'm going to separate the shareholders' equity part as well, because that's really important to separate, and we will, otherwise we will see contradiction very soon. Shareholders' equity, generally speaking, includes earned and contributed capital. So I will just separate it into share capitals that's contributed, and unearned, I ignore the cumulative other comprehensive income for now. I just focus on retained earnings. So change in shareholders' equity can be decomposed into change in share capitals, common shares, increase, decrease, and the change in retained earnings. What are the change of retained earnings? We just saw it in the previous example. Two things, net income and the dividends, right? So now I decomposed in such a way that that's detailed enough for us to relate it to the financial, the statement of cash flow we will see. And I coded in color here. All these changes, if they're related to operating cash flows, I colored it green. And if they're related to investing activities, I colored it brown. And if it's financing cash flow, I colored it purple, right? So the green part will include net income. Well, net income is revenue and expense, right? So in our discussion of that haphazard example, remember the operating cash flow is related to revenue, cash collected, cash paid for expenses. So that will be covered in here, right? And then we made adjustment because we didn't use revenue, we used cash collected. And the difference between revenue and the cash collected is changes in accounts receivable. And the difference between, we didn't use operating expense, we use cash paid for expenses, right? And the difference between operating expense and cash paid for operating expense is in accounts payable. It's here, current liability, right? So I have it, that's what we look at, okay? Right, or like a revenue expense that's included in net income, and the difference between accrued measure of revenue expense and cash measure, their cash counterparts, like cash collected and cash paid, are in the changes of working capital account. And financing here was the change in building, non-current assets, right? And not financing, investing, sorry, investing. Cash flow is really a change in non-current assets, which is the building in our example. And financing cash flow, we have all three. We have notes payable that's paid off. We have shares issued, result cash inflow, and we have dividends, right? So you see how it's all tied together, how it's all tied together. Okay, so operating activities, usually it's activities related to revenue producing activities, making products, providing services to earn a revenue, and the cost incurred to earn those revenues, right? So the inflow will be receipts from customers, outflows will be maintenance, and organizations system related costs, related payments. Operating cash flow from users' perspective is very important because that's the only sustainable cash flow, right? You can get cash by borrowing money, but you have to pay it back plus interest. You can raise cash by issue shares, but then you know if nothing else changes, then you can't issue indefinitely. The share will be devalued, right? Diluted, right? You can sell your equipment, that's investing activity, but after you sold all your equipment, you got nothing left, and there's a finite amount of equipment you can sell, right? But operating cash flow, if it's healthy, you can count on it to repeat indefinite, right? So that's really important. On top of that, you know, early on companies always issue shares, borrow money, and you always, yeah. So eventually you need to pay back those money. You need to pay dividends, right? And also you need to update, reinvest in your infrastructures, plants, property, equipment. That all ultimately has to come from the cash generated from operating activity. So that's why it's very important. Investing activities involves acquisition and disposal of long-term assets and other investment. Okay, so investing cash flow section of the statement of cash flow also reveals a lot to us, right? So for instance, if a company does not have investment at all, what do you think will happen? It doesn't mean the company will stay constant. The company will shrink, right? Because PPE gets used up, you know, and even if you just maintain the scales, you need to keep investing. Okay, now a new company, growing company, obviously would have to invest a whole lot more than the depreciation, right? So that Usually, investing activities have a negative cash flow, right? Because the cash generating activity will be sales of the assets. And so usually it's you get less than the amount you paid when you purchase new assets, with a little bit of exception, like when you read this part, right? So if for a new company, well, sometimes like if you look at the Tesla's company's statement of cash flow, so what they do is they need money, like a new company or fast growing company needs a lot of money, and they haven't reached the stage they generate a lot of cash flow yet. So they will raise money by issuing shares or borrowing them, right? So usually they issue shares, borrow money, if opportunity is there, like Tesla issued a lot of shares, they have a lot of money, cash, than they currently need, because there's an opportunity. The share is very high. You know, if you watch the news, a lot of people predict that there's a lot of people, companies short them too, because they don't think it will stay that high. What did they say? If Tesla maintains its current sales level, it takes 1,000 years for it to earn enough to justify that stock price, right? So what Elon Musk is very smart. It goes, fine, it's a high, I will issue shares, raise this money, because if the price is low, I issue the same shares, I won't raise nearly as much. So it is flush with the cash, and then what they do, they invest it. And when they need money, they will sell their investment, right? So that's part of that as well. So the investment include the investments in financial investments and the operating capital investments. So we need to separate those two. The capital investment part is definitely negative, right? And so that's that. Financing activities result in changes in the size and the composition of entities' capital and the borrowings, two ways to finance, right? That through debt, through equity. And so usually this three pieces is this. The operating cash flow, the company cannot decide to say, oh, operating cash flow is good, you're telling me, I'm gonna double it. You can't. You have to earn it, right? You operate in a competitive environment. You have to actually earn it. There's a constraints, but usually this is how the decision about cash flow goes. So operating cash flow is the result of operating activities, of your efforts, of your competition, and all that. So it's like you can't really. You can try, but you don't have control to say, I'm just going to double it, I'm just going to triple it. You have to actually work for that. Investing cash flow is the result of strategic decision. If you decide to expand, you're going to spend a lot. But you can also decide not to expand, then you don't have to invest a lot, right? So this is determined usually at a high level based on you understand the overall objective of the business, long-term vision of the business, and long-term strategy of the business. Financing cash flow, it is dependent on the other two. So this is your strategic decision. You're going to expand, say, in Africa, and you're going to invest a certain amount. Then how much operating activities can provide? If the operating activities can provide a lot of cash, more than what you need to expand in Africa, then extra cash should be either used to pay dividends or reduce debt. So that's usually, you should not keep cash if you don't have a good use for it. It's not your cash, you should return it to shareholders or use it to reduce debt. However, if the expansion requires more cash than operating activities can provide, you go to raise funds through financing activity. Okay, you can issue debt, you can issue more shares, depending on like the financing structure you aim for. So that's usually how that works. Okay, so this part of the statement cash flow should reflect that, and you can see the financing structure. Is there any change in the financing structure? Too much debt is risky. We know that. But debt is a less expensive source of capital. So if the interest rate is low, most the company, even they don't need it, they will have some debt because that's kind of good. There is a couple of exceptions or special items that we need to talk about. One is the interest. Okay, as I mentioned, that income statement focus mostly on operating activities, but not entirely, right? Because if you have interest expense, it's related to the money you borrowed, that's financing activity, but interest expenses in the income statement as well. Okay, if you have investment, you may get interest revenue or you may get dividend income. That's related to investing activity, but interest revenue and dividend revenue will be also reported in the income statement. Okay, so they're in the income statement, but where do we put them in the statement of cash flow? Under ASPE, it's interest and dividends received, earned, they're operating. Interest paid is operating, and usually this is operating if recognized in net income, that's interest, right? Financing if charged to retain earning, that's dividends, right? Dividends paid is not expense, right? So in other words, that under ASPE, if it's in the income statement, it's operating. If it's not in the income statement, it's not operating. That's it, right? It's not really consistent because the interest expense should not be like even in the income statement, we don't call interest expense operating expense, right? We don't call interest and dividends received as operating income. So this is the exception. This is the exception, okay? So they kind of treat it that way. This is the exception. We just need to know it, okay? It's inconsistency. There's an inconsistency in here, but that's how they do it. That's not the best way to do it if you according to some people, but that's what the people have been doing for a long time, and that's what they're doing. ASPE allow people choice, okay? So both dividends and interest received and paid, company can decide. So in other words, company would look at the essence of these transactions and then decide whether they should call it operating and investing. So for instance, they can justify in interest expense, they can justify interest revenue as operating as well as investing. So give you an example, if you have like extra cash and you invested in stocks and you received you invest in bonds and you receive the interest, you can, bank will definitely call it operating because that's their job, right? And you can call it a financing if you're like automotive manufacturer, you're making cars, that's your operating activity. So investing in bonds is not your core business, so that is definitely not. However, if lots of car makers also have a financing division, they offer car loans, and that would be different. So for one, that's the main part of their business, offer lots of car loans. And secondly, the reason they offer car loans is to promote sales. So you can justify that interest earned throughout the car loan is operating cash flow, right? So basically, you look at the essence supposedly, and then to decide what it is. Okay, this will be the last thing we talk about. So like there are exceptions. I'm talking about exception inconsistency, right? So if company have interest expense under SB, it's in the income statement, so it's operating cash flow. Okay, so however, if company sells PPEs, if there's gain losses from the sales, it's also in the income statement. But the cash flow associated with the selling of PPE is not operating cash flow. So it's inconsistent because you can't say if it's in the income statement, it's operating, because gain loss of sales of a PPE is in the income statement, but it's not operating cash flow. Now, how do we do that? This is one of the things like one of the complex topics here. So let me give you an example, exception. So let's say we have an example. Let's say equipment with a cost of 100,000, accumulated depreciation of 80,000, is sold for $25,000. Okay, so how do we record that transaction? This transaction affects income statement, balance sheet, and the statement of cash flow, all of them. Okay, so how do we record this transaction? We will have a cash of 25,000. Yes, so that's the proceeds, that's the easy part. And the equipment is gone. Keep in mind the equipment has two accounts. We need to remove both accounts. So equipment PPE part is 100,000, and we also need to remove accumulated depreciation, which is 80,000. Other way around, sorry. To remove it, it's a debit, accumulated depreciation, credit equipment, right? Because that, to remove it, we need to do the opposite. We need to plug something because debit and credit are not the same, because there is a gain, right? So the book value of the equipment is only 20,000, but it's sold for 25. So that implies there is a gain of 5,000. Okay, so that's our journal entry. So this amount is in the income statement. But that's not cash. What's the cash? 25,000. So this amount is in the statement of cash flow, right? Because that's cash. And in fact, this should be investing. Cash inflow. Yes, that's that. And these two will be removed from balance sheet. These two will be removed from balance sheet, right? So keep in mind that this part, the gain is in the income statement, part of the net income. Okay, but that's not cash. And in any case, the cash should not be operating cash. Cash should be financing cash, right? So let me take us back to this little analysis we did here. See, changing cash is net income, adjust changing working capital, right? So now, and there's, in addition to these adjustments, there should be another adjustment that's included in this is a gain from sales of PPE. And that is not cash. And that caused the net income and the operating cash flow to be different. So therefore, as part one, we do the adjustment, we should remove that. We should remove that because the gain is not cash. And instead that 25,000 inflow will be added here. How do we remove that? Knowing there's a gain from sales of equipment included in net income, and that gain is not cash, a gain is not operating cash, so we need to remove that. How do we remove that? We need to decrease. When there's a gain, we subtract, right? When there's a loss, we add. One of the very common mistakes when we make those adjustments, people go, gain, I have to adjust it, I add it because it's a gain. No, gain was already included and it should not be included. So we need to subtract it. Yes, yes. So that's it. Exactly. So that we're talking about that. Other one is payment of debt, which is a financing activity. However, sometimes if you retire debt early, we talked about this when we talked about the bonds, like bonds payable is recognized when bonds are issued, right? And the issue price of the bond is determined by the market rate. Market rate changes all the time. So after the bonds are issued, if the market rate changes, the bond price will change. We don't care because the borrower have a contract with the lender. You're going to pay fixed amount of interest. You're going to pay the principal. That's it. So it doesn't really affect the borrower unless the borrower going to pay off the debt early. Because if you pay off the debt early, you have to buy back all the bonds at its fair value. And if the fair value have changed, because the market rate changed after the issuance of the bond, you may have gain or losses. And that's the same thing. Those gain losses will be also included in the income statement, but cash paid to that gain loss is not cash. The cash is what you pay to retire the bond. And that is financing cash flow. Okay, so that's another one. This exception is also, this will be the last exception I talk about. Okay, it's we talk about investment. You talk about the investment in previous class. Yeah, for marketable securities, you remember, we have marketable securities, which is the investment, could be in equity, could be in debt, which are like actively traded. And so for equity, all the marketable securities are fair value through net income. And for debt, there's a bit of difference. There's available for sale, it's not, but trading, right? Trading securities are all fair value through net income. So that means for these investment in held for trading, investments for in equity, like that's not with the significant, not counted using equity or consolidation, they will be fair value through net income. Debt held for trading would be fair value through net income, right? So what happens is you have gain losses, but there's no cash. Because what you do is at the end of the accounting period, if the fair value change, you recognize gain losses, but really until you sell it, there's no cash. So those amounts will be, first of all, will be non-cash. So we have to adjust for that. But when you do sell it, you have cash. Even though those activities, in theory is considered investing, the cash flow associated with those investments are called operating. Why? Why? Because they are held for trading. Okay, so from that perspective, how trading is actively managed, right? You basically timing you buy and sell with the movement of the market, try to profit that way. So in that sense, it's no different from inventory, because you buy and sell inventory to make money. And for trading type of investments, you buy and sell to make money, right? So it's different from other type of investment. So for that reason, the cash flow associated with those trading, available for trading or trading securities are considered operating. So that's another exception. Okay, so that's good for today. I think that's a good place to stop, and we'll see you next class. You're just stretching, don't have a question, do you? Okay, any other questions, people online? Okay, if not, see you on Thursday. Bye-bye.